Good morning, everyone. Thank you for joining us. My name is Wayne Hiller van Rensburg. I'm the Executive Officer of the Institute of Retirement Funds Africa. We're excited to be hosting the webinar today. We'll just go through the process quickly. We have 3 sessions. First one we'll have from Net Group Investments. Second from, I apologize, not Net Group Investments. It is Old Mutual Investment Group we're starting off with. Then Net Group Investments in the second session, and Sasfin Asset Management in the third. Unusual format for the IRFA. We usually don't have, very specific type sessions like this. However, this morning's session is special in that we wanted to make it a investment masterclass and look at some of the things we don't always pay attention to. We're very grateful that all 3 topics being covered this morning are not things that we've covered recently or have not covered in the past at all. So welcome to everyone. Just a reminder on the process. If you have any questions, please post them in the chat or in the Q&A. Alternatively, raise your hand and we will give you an opportunity. As I know that for session 1, the preference is that we will deal with the questions at the end. But before we get there, I want to hand over to the IRFA President Geraldine Fowler to just welcome us all. Over to you, Geraldine.
Thank you very much, Wayne, and a warm welcome to everyone that has joined us, our delegates, but especially to our sponsors, Old Mutual Investment Group, Net Group Investments, and Sasfin Asset Management. As we aware, the IRFA is a non-profit organization, and the work that we do in the ecosystem of retirement funds is not possible without our sponsors. So therefore, it really is special for us to have you guys with us. We truly appreciate it. And we all know that in order to create better outcomes for the members of our retirement funds, but not just the members of retirement funds, for the people of South Africa and the African continent, the power of the collective is always better. And therefore, without sponsors such as yourselves, we cannot do it. So I'm not going to talk for much longer. I also just wanted to quickly take this opportunity to remind everyone our conference is the 5th and the 6th of September. You will at conference see Old Mutual Investment Group, Net Group Investments, and Sasfin again. We invite you all to please join, register. It is really going to be the event of the year. And then lastly, for all our women delegates that is in this webinar, if I don't see you again before the 9th of August, happy Women's Day. Thanks very much, and back to you, Wayne.
Thank you, Geraldine. Before we get going, and I know Maahir is I'm sure keen to get going after all the work that he's done there. Just a quick intro here. We'll share the slides later on so everyone can read Maahir's sort of qualifications and experience here. So we won't go there. No, the picture looks a little different. Maahir can explain that to us at a later stage. Enough said in the fact that, I mean, we're dealing with a person in an organization of expertise, and what that expertise is going to look at is a whole set of ethical investing principles, ESG, and the conflict between Russia and the Ukraine. Maahir, I'm going to stop here. Just always a reminder to anybody who has any questions, you're welcome to give us a call. You're welcome to drop us an email either to myself or to my colleague Putipadu at reception, and we'll get it through to you. And now I'm going to hand over to you. Thanks, Maahir.
Thank you, Wayne. Can you guys see? You guys see my presentation? I felt like I've said that so many times when this virtual presentation happens. Wayne, if you can just confirm that you can see the presentation, and then I'll begin.
We've got it, and we're going to get it on the big screen for us now. There we go. It's right there. You can go. Thanks.
Perfect. So thanks for the introduction, and thanks, Geraldine. I'm really looking forward to this. It is what I do on a daily basis, and I think this masterclass is very important in terms of education, because that's where awareness really starts. So I'm going to talk a little bit about ESG investing, Sharia investing, how it intersects, and then I'm looking forward to the questions as well at the end. So we were waiting for this guy to present, but I'm going to do the presentation. No, I am the same guy. There's a lot going on in the world, so I didn't have a chance really to cut my hair. And I have picked up a few kilos, but it's not important who I am. I'm going to deliver this. Just it's important to know that I'm a portfolio manager at the Old Mutual Investment Group in the Sharia and ethical investment space. So that's my wall of worry, the thing that really keeps me up at night. And there's a lot going on. There's China, supply chains, valuations, but so I mean, in terms of a webinar, there's a lot to talk about, but we're going to focus on the Sharia compliant and ESG aspect. Now, sustainable investment thesis, when we looked at the data to see why do companies perform better in the same industry or relative to their peers, there were a couple of characteristics that stood out. And those on the left-hand side, like your lower cost of capital, which is just the, you know, the way we borrow, how cheap that is to get good business growth, lower staff turnover and high productivity, really speaks to the culture of the business. Brand trust and loyalty is an important one, and obviously stronger R&D, but also, you know, lower reg risk, which is just the red tape that certain companies have in the arena of operation. So to outperform relative to peers, those were the characteristics from a sustainable level. And I just want to sketch the landscape in terms of also educating the audience of what we are dealing with. So ESG, Sharia, ethical, sustainable investing, whatever you want to throw under the umbrella, really has increased in terms of both flows. There was a record number of flows into sustainable funds up until 2019. And then also, there's been a big interest. So the shift of that interest has shifted from 71% to 85%. But if you look at the graph on the right, it's interesting that, and I think the important thing about the graph on the right, if I can put that up front, is that the flows are still positive into that sustainable space. That's very important. But it has come down somewhat, and you can look at that in various ways. There was COVID, so there was a pent up savings that happened, and then because of COVID itself, people were thinking in a more ethical, moral mindset in terms of, well, perhaps, you know, we should be in ESG or Sharia funds or ethical funds. And then there was the opening up of economies, and I think that's part of it, but there was also the war. Now, generally, when we look at flows, there is a strong correlation of good performance and flows. And I think that's important to note. So when the war started, prior to that already, energy was doing exceptionally well because there was an upward trajectory of the oil price. So now while certain ethical funds or ESG funds specifically excluded those sectors and those shares, they would have lagged in terms of performance. So there's that aspect as well. But the important thing, I think, to take out of this is that the flows are still positive and we are in it for the long term. How does that look? So I've showed you the global graph. How does that look on our side? We are still seeing very good flows into our, I don't want to use the word ethical franchise, but into our Shariah and ESG funds. So we are still seeing good growth. And in terms of just digging down deeper into the landscape and who are actually interested and who's investing, if we just dissect that a little bit further, millennials, there's definitely a growing level of awareness and desire for ethical investments. And we can see that on the Sharia fund side. Now, while on the 60+ age band, there weren't ESG funds and there weren't ethical funds and there weren't Sharia funds 20, 30 years ago. I guess so that also explains why the bulk of the AUM, the assets under management or flows, are within that age band. But I don't think that can be ignored. I also think there perhaps is a bit of a bias because the millennial is telling you that there's an increase in awareness. So don't believe everything I say. But then we also compare that to the industry proxy, which looks very different. The other thing is, which Geraldine mentioned, is it's Women's Month, and there is definitely a larger inclusion of women within the investment space, but also within the funds, if we dissect that. And it's probably good to mention that actually within the Sharia space, 25% of the individuals that make up our AUM are actually of non-Muslim faith, right? So non-Islamic faith, which is interesting, and it should get you thinking about why would an individual that is not Muslim be in a Sharia fund? And it's for those very reasons about that ESG overlay and the moral compass. And of course, there are things like performance, which can be tracked, but it really boils down to what an individual is looking for in terms of investments. So there is a strong intersection between ESG and Sharia. On the ESG side, they're looking at environmental, social, and governance issues, where on the Sharia investment side, it's a principles based that hasn't really changed for over 1400 years. And if we really look at what that means, it's really to do no harm, and there must be mutual benefit. And that brings me to the concept of shared values. Now, what the shared values concept is, especially in investing, is looking at, okay, the economic benefit, the objective of the client, saying, I've got to get the best outcome I can for the client from a commercial point of view. And that's purely based on returns and making those good investment decisions. But in the same time, while making those decisions for the clients, can we have an impact? Can we do something either to the environment or socially that can actually benefit the client in a different way? And that's really what the concept of shared values is. So there are really two tests to get to an ethical universe, and that's the nature of the business. So at the outset, on the Sharia side and the ESG side, we're going to throw out companies, alcohol, weapons, gambling, etc. And that'll be evident on the next slide. But then there's the quantitative test, and this differs between ESG and Sharia. On the ESG side, it's more the perceived controversy score. And then on the Sharia side, it's more about the IRFA rules, which is the Accounting and Auditing Organization for Islamic Financial Institutions. So while it's a mouthful, it's a board in Bahrain that have set certain rules in place from a quantitative perspective. And if the rule breaches, then the company then falls out of the universe. And then post-investment, on the Shari'ah side, we've got something that I'm going to touch on later, which is called the non-permissible income. And that's going to be quite interesting for those who don't know what that is. So on the ESG side, if we just look a little bit deeper, you have the exclusion of fossil fuels. You have a company that has a low ESG score, whether that's the E, the S, or the G, or all three in aggregate. And then you've got the low UN Global Compact score, which is really takes labor, human rights into consideration. And there are 10 principles there. And then there's the controversies monitoring in terms of, are you using child labor to work in your factories? Have you guys spilled oil in the ocean while drilling, etc.? I mean, on the Sharia side, there are pork products, conventional financial services, which are banks, highly levered companies, which is part of the IRFA rules. And then there's the intersection of ESG and Sharia, which is your alcohol, adult entertainment, gambling, tobacco, and weapons. Now, why this slide is the crux really of this webinar. It's important to know that if you invest in these funds, when the funds are going to outperform and when the funds are going to underperform. Now, in my piece that I put out, which this webinar is really the back of the piece that the thought leadership piece that I put out in our fundamentals magazine, is that when ESG was excluding fossil fuels as well as weapons, you had an increase in oil price, and then you had the war, which exacerbated this. Okay, because Russia is a big commodity company, sorry, a big commodity country. So you had, besides the increase in oil price, the war exacerbated further to run to almost $120 per barrel for oil. It's now currently sitting at 100, so it has come off a little bit. But through that time, excluding companies whose core businesses is doing oil or energy would have hurt ESG performance, right? And then another interesting stat from the Bank of Merrill Lynch, they actually stated that developed countries are increasing their spend per GDP on security, which just means that they will buy more weapons. And while they do this, if you're not holding those companies, well, then your portfolio could underperform. So that's a really, really important slide. In terms of how we incorporate ESG is one, through the investment process. And how we do that is we've got a separate business of 6 or so analysts who sit in our ESG space, who their daily job is only to work on ESG, do our proxy voting, engage with management around ESG issues and how they can better their company's ESG profile. And then in the alternative space, under our green roof at Old Mutual, we've also got an alternatives business, which JV and build JV with other companies and build schools. We've got the impact fund. We've got they put up solar and wind farms, etc. So we've got that. And how we're trying to incorporate that specifically in the Sharia funds is through the sukuks. And then there's the non-permissible income. Now this is very important because I brought it up on an earlier slide. Every single company has an income statement, and in that income statement, it's got an interest income line or a finance income line, depending on how they disclose it. Now, interest income in conventional banking is non-permissible in the Sharia space. Whilst permissible in the ESG space, it's non-permissible in the Sharia space. And what we do with that, we look at every single company that we hold, we do a weighted calculation, and we pro-rata that, and we strip that out of our unit price on a daily basis. So just think about that. Here's a fund manager talking to an audience saying that if you invest with me every single day, I'm going to take a very, very tiny amount of money away from your unit price, and I'm going to give that to charity. And that's exactly what we do. And you've seen the flows. Investors that invest with us know that we do that. And we use that money to make a direct impact on the SDG goals. And in terms of all the SDG goals, there's about 13 out of the 17 SDG goals that we hit and make a direct impact in communities. We donate money to education, and just in terms of our AUM this year, we probably donating around north of 27 million. Now, while that sounds like a big number in absolute terms, if you look at it over our AUM of roughly 8.5, 9 billion, it's actually not that much, but you can do a lot of good with 27 million, right? So poverty alleviation, health, and then when there's a need, the trust will allocate, like there's a water crisis in Nelson Mandela Bay right now, and then the trust will direct those funds to a need. But the thinking around the trust is also sustainable. And what I mean by that is they would open a baking school in a rural community. That baking school will then employ, make products, sell it out into the community, and that's a cycle of giving money to somebody or to an organization that is where we're not a grant funder in terms of everyone's putting up their hands, I need. So that's the thinking around the trust. So I'm going to take you through a real case study, which I'll incorporate a discipline framework to look at companies as well as the ESG part of it. And our philosophy is really based around high quality companies that are attractively valued and that have a good growth pipeline. And while we do that, we also manage risk. So the famous ice hockey player, Wayne Gretzky, he said, I skate where the puck is going to be, not where it is. And the reason I put that slide in was to show you that we don't always just invest in AAA companies like a Vodacom. We will look at companies where the investment case makes sense and there's an improvement in ESG. So I've put two examples up of Shell and Sasol, and you can see that Shell scores a lot better. And the reason why Shell's got the bump up from A to AA is really around they actually sold off some of their assets that were on the E side, was really what we call an environmental liability. And then on Sasol side, you can see that they actually dipped and then they came back up to BB. And that was because of a sitting between Old Mutual's ESG team and Sasol to say, this is actually what you guys are not great at. This is what you need to improve. And then on the governance side, they actually put that in place. So from an active stewardship point of view, Old Mutual also plays a massive role in terms of how to get certain companies where they need to be from an ESG an ESG arena. In terms of transparency and reporting, Sasol had none of these things. They had no revenue lines in terms of their metrics, and they're only in the infancy of their journey implementing this ESG framework and cycle, which was due to the fact that Old Mutual actually sat down with management to discuss how to do that. But if we look at Shell and Sasol, they basically they basically do the same things. They get in Brent crude and then they dissect those products for bitumen, petroleum, etc. And let's just see how the ESG scores stack up. If you look at the ESG profile score, so 10 is the highest and 1 is the lowest, you can see that Shell is the clear winner there at roughly 7 versus 3, which automatically puts them, Shell, in a better quintile than Sasol. But if you look at the total greenhouse gas emissions, and really that's a fancy name for pollution, and how they affect our environment, and you look at the size of the market cap in terms of the different businesses, you can see that actually while the greenhouse gas emissions of Sasol is very similar to Shell, they're a tenth of the size. So Sasol is really doing a bad job in terms of the environment, while Shell is, I guess, also, but they're a lot bigger, and they have better frameworks in place for that energy transition and that net zero carbon. And then from an investment point of view, if you look at Shell and Sasol and you needed certain exposures to energy, and if you were exposed, you would have done exceptionally well. But just with an investment mindset and with our framework in terms of quality, value, and growth, how do they compare against each other? So cash flow return on capital employed is part of our quality basket and our quality factor. And these are just to unpack a bit of the fundamental metrics which make up our factor basket. We use a systematic approach. And if you look at quality, Shell's got better quality than Sasol. Their default probability, and what this is the ability to pay back their debt, or if they are in any way going to default on their credit. And this is in a percentile, so which means that if you're in the top percentile, you're a lot better. If you're in the bottom percentile, you're a lot worse. And then you can see that Shell is much better than Sasol. And then from an earnings per share growth, on a 3-year average, you can see that Shell has done a lot better. And then from a valuation, cheap or expensive, attractive or not, if we look at the PE ratio over there, the lower the PE, the better. So Shell, from an investment point of view, a clear winner. So with our framework, quality value, Shell has better quality, attractive valuations, a good growth pipeline. I mean, Shell is one of the largest liquefied natural gas plants relative to peers, and it's got decent and improving ESG, which we believe is best in class in the energy sector. And then I had to put this in, and this is really not to show the incredible performance. Well, while it does do that, it's more to debunk myths. And what do I mean by debunking myths? I often get asked the question that Shariah compliant funds or ESG funds are going to underperform due to the smaller universe. This is a clear graph, and this is the from Morningstar, so it is published. And please don't take it from me. Go do your own research and have a look at the performance numbers. But it shows that Shariah compliant and ESG funds using this framework can outperform, besides their benchmark, but conventional funds, non-Shariah, non-ESG funds. And I think that's the most important message coming from the slide. So if you want to preserve the planet, you want to help humanity, and you want to achieve great investment returns, then maybe, maybe these are the funds you need to look at. And whenever I speak to institutional clients or to retail clients, it's evident that they only put certain solutions in front of a client if they're specifically looking for a Shariah solution, or they're specifically looking for an ESG solution. But this should actually be seen as an asset class on its own to bring greater diversification and be part of a conventional product mix. So to conclude, I've discussed shared values, which is your economic benefit, your returns, as well as your social impact. There's clearly favorable demographic tailwinds in terms of millennials and female investors, and there's a clear increase in flows to sustainable funds, which we've seen. It's come off, but it's still positive, where on the global side and conventional side, it's actually negative. And that Shariah and ESG investing can outperform conventional funds. And while doing all of that, I think let's not take away that we are also making real grassroots impact within communities and delivering on those impactful and sustainable methods. So thank you. I can't see the time, but I'm sure I did that in under 35 minutes. I'm not too sure.
You did indeed.
I'd like to make this very conversational, and hopefully there are some questions.
Thank you. Let's open the floor and invite questions from anyone. I see Geraldine's given us a comment. Are there any other questions? Anybody who wants to maybe ask the question in person, just raise your hand and we can give you an opportunity. If not, any questions online? I have some questions while you were talking, just to start off the conversation. Sure. I think, you know, for many people in the audience, you know, we may be members of a board of trustees or you know, an advisor to the board of trustees. And when we think, maybe I'll put it into three areas. Firstly, it's sort of ESG, then the Shariah option, and you mentioned somewhere along the line that you said maybe it should form part of a mix. And so maybe let's talk investment, you know, so it's like an investment policy or investment strategy there. So starting off with the ESG and just that question, so it sort of ties back to question number 3. I know you're very focused on the product, but in your mind, how would if I'm sitting on a board, and then if I'm asking you a silly question, just stop me, you know, consider these things, because, you know, obviously I'm guided by my advisors, and the laws said for a while, you know, there's that guidance note from 2019 that says you need to consider ESG, and when I look at the methodology you put forward and your principles, there's so many. I think, you know, I'm overwhelmed when I have to, you know, consider ESG and then incorporate that into an investment strategy or policy.
I think there are enough vendors in terms of where even trustee boards or companies can subscribe to an ESG score or an ESG metric, and with doing that, they'll get a good understanding of what the good companies are and what the bad companies are. That's a very good question in terms of what I call the show me or the prove it question. And as you could see from the Sasol example versus the Shell, Sasol wasn't doing a great job. Now, you can never know if they're really doing a great job if they're not transparent with their metrics. They don't actually measure their metrics. So I think from a trustee point of view, they could look at a snapshot of the portfolio weighted to a certain score, and they could say, well, listen, the last time I sat in front of you, you showed me that your portfolio has a score of 6.5, and the benchmark at the current time was sitting at 5.5, which was great, but I see that somewhat has switched around. And please explain why that is. And then the fund manager would have to answer that question in terms of why they made the decisions that they did and why the ESG score is a lot lower.
So without sort of reducing the things you're saying there, just if I put it into an action, I would say, you know, if I'm developing the strategy, obviously I'm going to mention ESG. I mean, the policy, I'm going to mention ESG. In the strategy, I'm going to put in the metrics, and then you need to decide how you're going to obtain those the metrics from either your provider, whoever the provider is in the value chain.
Correct. Because some fund managers are not going to be big enough to have a fully fledged ESG team only focusing on ESG. And that's the reality, but there are enough providers, Wayne, where you can get a good breakdown of how your fund looks versus the benchmark on an ESG basis.
So maybe if we can come back, thank you. I think that's a great answer. We have one question, one of our board members and exco members as a question, and we can get back to the Shari'ah maybe in case, you know, Enos has a question related to this. Over to you, Enos Ngachane, one of our IRFA board members and exco members. Thank you, Enos.
Thank you, Wayne. My question is around the board itself. I think you mentioned that the board is based in Bahrain. I just want to understand what are the functions of the board and what mechanisms are used by the board itself, you know, to monitor compliance from associates or country members. Thank you.
Thanks, Enos. That's a great question. So the IOFI board is the body that sets the standards in terms of the ratio. All Sharia compliant funds primarily follow that ratio. But then we also have our Sharia boards. So where our competitors will have a different Sharia board, and we'll have a different Sharia board with different scholars. The functions of that board is purely to keep compliance intact. So to make sure that the universe is what it is, you know, individuals saving in the Sharia fund or in a Sharia fund could actually be saving for pilgrimage. So while we purify that unit with a non-permissible income, the board makes sure, one, that the non-permissible income is actually stripped out and paid to charities. They also ensure Sharia compliance in terms of the ratios going over or breaching mandate. And an example of that is that I'm sure everybody on the call knows MTN, so I'm going to use that example. But if MTN goes out and goes and makes an acquisition for the old SAB and our Zabush, the Sharia board then is there to say they've made this acquisition. It's a big part of their revenue. This now falls outside of the universe. So that's the main reason for the board to ensure Sharia compliance. And they also issue a Sharia certificate, just like there are institutions that issue a halal certificate that your restaurant is halal. They issue a Sharia certificate. So that would be the primary function.
Thank you.
Thank you, Enos. I just having a look here. There are some questions as well. So maybe if we want to, we only have a few minutes. So I'm just having a look. So Kizwa and Gema asked, you talked about the impact of the fund, which are based and how are these based on, sorry, I'm just reading Jakoet. So I think it's about, the question here is, how do you set those criteria and your impact criteria? Yeah. You talked about, sorry, you talked about the impact of the fund, which are based on ESGs. Are these based on a set, on set targets that have been developed by the fund manager? If so, how are the companies performing against this? How were the targets set? So does it make sense? Sorry, I rambled a bit there.
Yes, yes. So every single company is going to have an ESG score, which is a proprietary ESG score that we build out. So that we incorporate into our portfolio optimization in terms of a hurdle. We would always want to be better from a fund point of view than the benchmark. That's the first thing. The other impact criteria is on the NPI that I mentioned, which is the non-permissible income. Okay, so while that needs to be stripped out, what we do with that is important. So we pay it over to a trust, and that trust is an independent trust that then allocates the funds. So from an impact point of view, we can't take that non-permissible income and go run a big marketing campaign. No, absolutely not. We're not going to do that. And we also want independence, and that process gets audited as well, in terms of where that money goes. And that money does not just go to Islamic institutions or Muslim institutions. Red Cross Children's Hospital is a big beneficiary of that. And where there's a need, like old age homes, and in the time of COVID, they needed oxygen machines. So that would have happened. And then again, as I mentioned, they opened a baking school, which is more the sustainability thinking coming through in terms of that strategy. So I think I've answered that impact from a fund point of view, as well as from the actual grassroots impact point of view.
So it's basically sitting down, defining the principles, and then seeing how you want to direct your impact. And you've been guided by the SDGs, if I understand correctly, but there could be other, ways in which you want to do it. But the SDGs are quite a well-known.
Absolutely, yeah.
So we nearly run out of time. One last question, which I thought is interesting and more, let's say, structural, legal type question. And if you can't, we can always refer to somebody. Not that I'm saying you can't, but if we don't have time, is the question here as how can ESG Shari'ah investing, I think probably more Shari'ah investing, be integrated into underwritten funds? So I don't know if you understand the whole.
I'm not sure if that individual is asking from a product point of view in terms of a wrapper structure and life, more life company.
That's it. So an RA would be a policy, and your investment would be a policy, and an insurance policy.
Yeah. So that I'm going to try to answer the question the best I can. It's not my forte. I'm not in the product space. My responsibility is to make the best decisions from an investment point of view, but from a product building perspective, it's more of a financial advisor question. I do know that Old Mutual does provide a Sharia compliant wrapper, but that's about all I know.
Don't stress. I think it's a good question. Yeah. I think it's worth something that would be on people's minds. So we'll take it away and ask someone to help us with a full response there on that structuring.
100%.
Thank you. I don't know if you want to have a closing remark or two. It's been great.
Yeah, Wayne. I mean, I just, I really value these sessions. I think, as I mentioned, education is important, and I would have liked a little bit more interaction perhaps at the end. And I know the feeling that this is a live webinar. There looks like there's 67 participants and people are shy to answer, to ask questions. But please, don't let that question hang. Send it through to Wayne and we'll do our best to get back to you if there's anything that you didn't understand. And yeah, I just appreciate that people took out the time today to listen to the webinar, and hopefully they're a little bit more educated about ESG and Sharia and the intersection, as well as how we do things here in terms of our active stewardship. So I must thank everybody for dialing in and listening to me. Thanks.